There's a certain intoxicating rhythm to a market in ascent. It whispers promises of prosperity, a siren song that can easily drown out the more sober notes of caution. We watch as prices climb, as headlines tout new records, and a powerful urge takes hold, the urge to participate, to ride the wave, to not miss out on what seems like an unending ascent. But beneath the surface of this collective euphoria, the market, much like the unpredictable character Benjamin Graham, named Mr. Market, can shift from a genial partner to a capricious force. His enthusiasm, when unchecked by reason, can morph into a dangerous recklessness. This video isn't about predicting an exact moment of collapse. Such certainty is a mirage. Instead, we're here to equip you with a deeper understanding, a more critical eye, and a reliance on the silent, unwavering language of data. We'll move beyond the emotional narratives and the fleeting headlines to uncover the quantifiable signals that betray an overheated market. These are the subtle shifts, the statistical anomalies, the data-driven indicators that the crowd often misses, blinded by the sheer momentum of rising prices. Think of it as learning to read the subtle tremors before an earthquake, not to pinpoint the exact second, but to recognize the pattern, to understand the forces at play. We will dissect what overheated truly means in empirical terms, moving past the gut feeling to a state of informed awareness. By drawing on the foundational wisdom of value investing, we aim to help you distinguish between rational optimism and irrational exuberance. Prepare to engage with the market not just as a spectator, but as an astute observer, armed with the insight to navigate its cycles with a steady hand. The first, and perhaps most insidious, indicator of an overheated market is the pervasive amplification of the fear of missing out, or FOMO. It's a collective psychological phenomenon that disconnects asset prices from their fundamental worth. We see it when retail investors, often spurred by social media buzz and a primal urge to keep pace with perceived gains, pour into speculative assets. This isn't rational investment, it's a chase. Think of the exponential rise of meme stocks or the stratospheric price-to-earnings ratios on companies with little to no profitability. These are not merely high valuations, they are screams of collective panic, a desperate scramble to join a party that might already be over. Consider it like a sold-out concert where demand vastly exceeds the venue's capacity. The ticket prices skyrocket, not because the band is suddenly 10 times more talented, but because of manufactured scarcity and the overwhelming desire of everyone to be there to experience it, to not be left out. This is precisely what happens in overheated markets. The price becomes detached from the intrinsic value of the asset, driven instead by the emotion of the mob. The siren song of this time is different, is often heard when FOMO takes hold. Proponents will argue that new paradigms, new technologies, or new economic models justify unprecedented valuations. But history, our most potent data source, tells a different story. The dot-com bubble, the late-stage housing bubble of 2007, these weren't anomalies. They were stark lessons in the destructive power of FOMO-driven exuberance. These historical tops are not mere anecdotes. They are empirical data points, revealing a recurring pattern in human behavior and market psychology. To spot this, look beyond the headlines and track the ratio of speculative assets, like unprofitable tech ventures or volatile cryptocurrencies, to more stable, value-oriented investments. When there's a pronounced skew towards the speculative and retail inflows surge into these riskier corners, it's a powerful signal. It suggests the market is not being driven by rational analysis, but by the intoxicating, yet dangerous, allure of quick gains. This indicator, then, is a blend of behavioral finance and valuation anomaly. When the music of FOMO plays too loudly, it's time to listen for the silence that inevitably follows. Our second critical indicator of an overheated market is what we can call the liquidity mirage. This occurs when an abundance of easily accessible, low-cost credit inflates asset prices, creating a deceptive veneer of economic health. It's a period where money flows freely, making everything seem robust, but this perceived strength is often an illusion, a mirage that masks deeper, underlying weaknesses. We see this reflected in metrics such as the dramatic growth of margin debt, where investors borrow heavily to amplify their positions, or in the widespread use of low-interest debt financing by corporations, often to fuel share buybacks. The expansion of central bank balance sheets, injecting vast sums into the financial system, further contributes to this mirage. Imagine standing in a desert, parched and weary, and seeing what appears to be a life-giving oasis shimmering on the horizon. It looks real, inviting, promising relief, but it's an illusion, a trick of light and heat. Abundant liquidity in financial markets can create a similar deceptive appearance of a thriving economy, obscuring the structural fragilities that lie beneath. This easy money encourages risk-taking and propels asset values upward, but it doesn't necessarily reflect genuine economic strength or sustainable growth. The hidden danger here is profound. When central banks inevitably begin to tighten monetary policy, raising interest rates or shrinking their balance sheets, this liquidity mirage begins to evaporate. The cost cost of borrowing rises, deleveraging becomes necessary, and the inflated asset prices, built on a foundation of cheap money, can collapse with startling speed. History offers stark examples of this. Periods of monetary tightening have often preceded sharp market corrections as the artificial support is withdrawn. Therefore, a crucial actionable insight is to monitor the trend of corporate debt issuance relative to equity buybacks. An increasing reliance on borrowed funds to finance share repurchases, particularly during periods of low interest rates, is a significant red flag. It signals that companies are prioritizing short-term stock price boosts over long-term investment or sound financial health. Furthermore, watch for an increasing demand for higher yield, riskier junk bonds. This indicates that investors, desperate for returns in a seemingly low-yield environment, are venturing into more perilous territory. The illusion of endless liquidity is a powerful force, but like any mirage, it eventually dissipates, leaving behind the stark reality of market fundamentals. Our third indicator to scrutinize when assessing a potentially overheated market is what we can term analyst forecast fatigue. In the euphoric final stages of a bull market, a peculiar trend often emerges. Analyst consensus forecasts for earnings and revenue growth become increasingly, and perhaps unrealistically, optimistic. Even as leading economic indicators begin to signal a slowdown, the projections for corporate performance tend to be revised upwards, not downwards. This phenomenon can be likened to a chef who, faced with ingredients that are beginning to lose their freshness, desperately tries to salvage the dish by adding more and more spices. The spices, in this analogy, are the upward revisions to analyst forecasts. They are an attempt to mask the underlying decay in economic fundamentals, to maintain the illusion of continued growth and prosperity when the data suggests otherwise. It's a way of trying to keep the market's spirits high, even as the foundation begins to crack. It's important to move beyond the simplistic idea that analysts are merely wrong. The issue is often more systemic. There's a tendency, driven by incentives, a desire to conform, or a collective herd mentality, for analysts to remain bullish even when the objective data points toward caution. By comparing actual earnings against initial expectations during these late cycle periods, we can observe this pattern. The consistent upward revisions, despite softening economic signals, become a telltale sign. As an actionable insight, diligently track the trend of upward revisions in analyst estimates, not just for individual companies, but for major indices and key sectors. When you observe a sustained period of these consistent upward revisions, particularly when juxtaposed with a slowing global economy or rising inflation, it serves as a strong indicator of an overheating market. Pay close attention to the subtle whispers of negative revisions that are often drowned out by the louder shouts of positive ones. When forecasts become a chorus of optimism that seems to defy the observable reality, it is precisely then that we must consult the data itself, rather than simply listening to the cheerleaders. Our fourth and often overlooked data-driven indicator of an overheated market is sectoral divergence. In a genuinely healthy market rally, participation is broad-based. It's a rising tide that lifts most boats, with gains spread across various sectors and industries. However, as a market becomes overheated, this broad participation often falters. Instead, the gains become increasingly concentrated in a select few dominant sectors or mega-cap stocks, while the majority of the market begins to lag, stagnate, or even decline. Think of it like a sports team where only one star athlete is carrying the entire burden of victory. While their individual brilliance might lead to a few wins, it signals a profound lack of depth and reliance on a single point of failure. If that star athlete falters, the entire team becomes vulnerable. This is precisely what transpires in an overheated market. The upward movement is sustained not by the collective strength of the market's components, but by the performance of a handful of giants. This concentration, this narrowing of market leadership, conceals a significant underlying weakness. When these few driving stocks eventually face their own corrections, perhaps due to their own inflated valuations or shifting investor sentiment, the broader market, which has been neglected and is already showing signs of weakness, can experience a much more severe downturn. There is little support from the rest of the market to cushion the fall. To identify this divergence, it's crucial to monitor market breadth indicators. These include metrics like the advance-decline line, which tracks the number of advancing stocks versus declining stocks, and the percentage of stocks trading above their 200-day moving average. Also, observe the performance of various sectors relative to the main indices. A significant divergence where the overall index is still climbing, but breadth indicators are deteriorating, is a classic, potent sign of an unsustainable, overheating rally. The market's true strength lies in its breadth, not merely its height. When the foundation erodes while the peak continues to climb, it's a structural vulnerability waiting to be exposed. We've explored for critical data-driven indicators that signal an overheated market, often missed in the fervor of rising prices. First, the pervasive FOMO multiplier, where fear of missing out drives valuations far beyond intrinsic worth. Second, the liquidity mirage, an illusion of economic health created by abundant, cheap credit. Third, analyst forecast fatigue, the tendency for projections to become unrealistically optimistic as economic fundamentals weaken. And finally, sectoral divergence, where market gains concentrate in a few stocks, masking broader weakness. These are not isolated signals. They are interconnected facets of a market stretched thin. Think of a detective piecing together a complex case. Each indicator is a crucial piece of evidence. Individually, one might be dismissed as circumstantial, but when they converge, when multiple signals point in the same direction, they form a compelling narrative, building a strong case for increased caution and rigorous risk management. It's the confluence of these data threads that provides the clearest picture. This understanding directly challenges the simplistic buy the dip mentality that often prevails in rising markets. When these indicators are flashing red, a dip might not be a buying opportunity. It could be the prelude to a significant decline. Attempting to catch a falling knife to time the exact top is a perilous game. Our goal, guided by data, is not perfect timing, but the prudent avoidance of catastrophic losses. Therefore, we can construct an actionable framework, a market heat score. By assigning appropriate weights to these four indicators, we can create a quantifiable measure of market risk. When this score exceeds a predetermined threshold, it serves as a clear signal to de-risk, rebalance portfolios, or adopt more defensive investment strategies. It's a move away from blindly chasing momentum and towards informed, strategic capital preservation and growth. The data, when interpreted with a discerning eye, doesn't lie. By understanding these indicators, you transition from being a passive spectator of market cycles to an informed participant, empowered to protect and grow your wealth through truly strategic decisions. We've journeyed beyond the headlines, beyond the emotional tides of the market, to uncover for crucial, data-driven indicators that reveal when a market has become overheated. We've seen how the pervasive FOMO multiplier can inflate valuations, how the liquidity mirage can mask underlying weaknesses, how analyst forecast fatigue leads to unrealistic optimism, and how sectoral divergence signals a worrying concentration of gains. These are not mere abstract concepts. They are tangible signals, woven from the fabric of market behavior and economic reality. Consider the timeless wisdom of Benjamin Graham, the father of value investing. He cautioned that the investor who claims it's always a good time to invest is almost invariably wrong. Our exploration today underscores precisely why that statement holds true. We've identified the conditions, the data points, that signal when it is, in fact, not a good time, when the risks begin to outweigh the potential rewards. The goal here is not to become a market prophet, predicting the precise moment of a downturn. Such certainty is a fallacy. True power lies in understanding the underlying mechanics of market cycles and, crucially, in building a robust, data-informed framework for risk management. This knowledge is your shield. It transforms your approach from one of reactive speculation, tossed about by the market's whims, to one of proactive, strategic decision-making. By applying these data-driven insights, you equip yourself to navigate the extremes, to protect the wealth you've painstakingly built, and to continue on the path towards sustainable accumulation with unwavering confidence and clarity. The market speaks in numbers. Learn to listen.